right, everyone. Hello. We're going to look at an example here from the Grade 12 Math Essentials curriculum. Good to see all of you guys. So let's jump right in. So it says here that you bought a house for $259,856. So again, this is how much money. So I just go and change colors here. So again, this is how much money the house costed. So that's the total purchase price of the house. It says here that the bank is offering you two options for your $200,000 mortgage. So this is how much money the bank is agreeing to loan you. Notice that they're not giving you the entire amount. They're giving you $200,000 in the form of a housing loan, which we call a mortgage, and you have to pay the rest. Okay, so the first bank is offering you 6% interest over a 20-year amortization period, and the second is offering you 6% interest again, only this time over a 25-year amortization period. So first things first here, we want to calculate our down payment. Okay, so the first thing we're going to do is the down payment is the amount of money that we're going to spend out of our own pocket. The bank is going to pay the rest. So if I'm buying the house for $259,856 and the bank is giving me $200,000 in a mortgage, if I find the difference between those two numbers, well, that's going to be my down payment. So there's my down payment. So fairly simple. That's all we need to do. For the monthly payment that we're going to be paying for that mortgage every month, we're going to jump and look at an equation. Now this equation here is not going to be provided to you on the exam, and it looks like this. So we're going to take our mortgage amount, we're going to divide it by 1,000, and then we're going to multiply it by something called the table value. Now, if you're like, oh, gee, I've heard of table values. What the heck are they? There you go. There's your table values. Okay, so going back, I have two options that we need to calculate for. So the first option here is 20 years at 6%. So my equation, we're going to plug in. Now, so I've got my mortgage. I'm going to divide it by 1,000. I need to find my table value here. Again, I'm looking at 6% over 20 years. So I'm looking at $7.12. Okay. Now, they could either give you a table and ask you to look for this number, or they could simply give you this number in the form of a sentence embedded in the question. So they could embed that within the question in the form of a sentence, and you need to pull that number out of the question and use it in your answer. So I'm going to multiply this by $7.12. So this is how much money I'm paying per month for this first mortgage option. The second mortgage option, all right, which is 25 years at 6%, all right. Again, I'm going to take my mortgage, so $200,000, and divide it by 1,000, and I'm going to multiply by my table value. So again, I need to go into my table, and 25 years at 6%. So if we go back and we go 6%, 25 years, we get $6.40. Be super careful when you're moving over to look for that number. I'm doing it quickly because I know the number I'm looking for. But again, if you're doing it for a brand new question that you've never done before, then you're going to want to make sure that you follow that, follow the numbers correctly and choose the right number. It's very easy to pick the number that's just above or the number that's just below. In this case, we want $6.40. So I'm going to go here and I'm going to punch in 640. And when I go into my calculator, I should get 1280 again per month. Okay, so those are my two monthly payments for each mortgage option. Lastly, it says here that we want to determine the total interest being paid for each mortgage option over the entire amortization period. So what we're going to do is we're going to look at option one. All right, so option one, I'm paying $14.24 per month, 12 months a year, for 20 years. And I get $341,760. That's the total amount of money that I'm spending over the course of 20 years. Now, if you're like, well, Mr. Lazarick, this amount here is significantly higher than my initial mortgage amount, the amount that I initially borrowed. I only borrowed $200,000. Why am I paying back so much more money? Well, that difference that you're paying back, that's the interest that you're paying back to the bank. So to figure out how much total interest I'm paying, so I'm looking for, again, the total interest here. To figure out that total interest, I take 341,760 and I subtract my initial mortgage amount. So that's the interest that I'm paying on this loan. Now, the second mortgage option, I am going to be paying $1,280 per month for 12 months a year, but this time I'm paying it back over a longer period of time, 25 years. And when I punch that in, I should get $384,000. And then again, to find interest, well, I simply go 384,000. I subtract my initial mortgage, and I get $184,000 of interest. Hope that made sense. And if you guys do have any questions, leave them in the comments below. Otherwise, happy studying.